Hello, it's your wealth coach here, and welcome to the beginner's guide to an ETF. What is an ETF and how does it work? You've been wondering what it is? Just take a seat and listen up closely. I'll give you everything. ETF, which means exchange traded fund, is a basket of investments like stocks or bonds. ETFs let you invest in many securities all at once. That's talking about many stocks and all kinds of commodities, okay? They often have lower fees than other types of funds and are traded more easily. Now, that's the catch. But as with all financial products, ETFs are not a one size fits all solution. You have some due diligence to do. So, what you have to do is evaluate them on their own merits, including management costs and commission fees if there are any. Okay? Then, how easily you can buy or sell them is also a factor because you need liquidity. Now, how they fit into your existing portfolio and their investment quality also matters. So, how do ETFs work? The way they work is the fund provider owns the underlying assets, designs a fund to track the performance, and then sells shares in that fund to investors. Simply put, an ETF provider considers the universe of assets, all kinds, including stocks, bonds, commodities, or currencies, and then creates a basket of them with a unique ticker. So it comes in the form of a company name with a ticker symbol that you can search on the stock exchange to buy and sell. Shareholders own a portion of an ETF, but they don't own the underlying assets in the fund. Even so, investors in an ETF that tracks a stock index may get dividend payments for any dividend stocks in the index. So while ETFs are designed to track the value of underlying asset or index, that's be it a commodity like gold or a basket of stocks such as the S&P 500, they trade at market determined prices that usually differs from that particular asset in the fund. So that is to say, investors can buy a share of that basket using their brokerage account, just like buying shares of a company. I hope you get that straight now. So the fact that you have certain stocks in an index doesn't mean you own the stocks directly. That's simply what it is. So also because of things like expenses, longer term returns for an ETF will vary from those of its underlying assets. So buyers and sellers trade the ETF throughout the day on an exchange, much like a stock. Okay, so there's no serious difference. This is just what it is. You can trade them just like you trade stocks on the exchange. Types of ETFs. Exchange traded funds may trade like stocks, but they more closely resemble mutual funds and index funds, which can vary greatly in terms of their underlying assets and investment goals. So they vary, but you can find a balance and then buy according to your investment goals. So here are a few common types of ETFs. Please note that these ETFs I'll mention are not categorized by management type, whether passive or active management, but rather they are categorized by the types of investments held within the ETF. So straight up, let's go on to types of ETFs. Number one, stock ETFs. These comprise stocks and are usually meant for long-term growth stocks. So while typically less risky than individual stocks, they often carry slightly more risk than some of the other listed ETF types here, such as bond ETFs. Number two, commodity ETFs. Commodities are raw goods that can be bought or sold, such as gold, coffee, and crude oil. So commodity ETFs lets you bundle these securities into a single investment, right? So with commodity ETFs, it's especially important to know what's inside them. For example, do you have ownership in the fund's physical stockpile of the commodity we're talking about? Or do you own equity in companies that produce, transport, and stores these goods? Well, Does the ETF contain futures contracts, for example? And then is the commodity considered a collectible in the eyes of IRS? So these factors you must consider, and they come with very serious tax implications and varying risk levels. All right? Number three, exchange traded notes. Please understand, exchange traded notes are technically not ETFs, but they are often confused with them due to their similar names, all right? ETF, ETN, and characteristics like ETFs. ETNs trade on exchanges as well throughout the entire trading day, and they track a basket of assets. Just don't mix it up. ETF is different from ETN. So ETNs often track commodities, bonds, derivatives such as futures, or more exotic assets such as carbon credits rather than stocks. That's where the difference lies. All right? An ETN differs from an ETF in that it does not actually own the underlying assets. Instead, it's a debt security that tracks the value of its underlying assets indirectly. What that means in practice is that an ETN's value relies on its issuer's credit worthiness. Remember, credit worthiness and the risk of an issuer default is worth considering when looking at an ETN, right? Number four, bond ETFs. Now, unlike individual bonds, bond ETFs don't have a maturity date. So the most common use for them is to generate regular cash payments to the investor. While normal individual bonds have expiry dates, these do not. So these payments come from the interest generated by the individual bonds within the fund. Okay, so it's a collection of bonds. Bond ETFs can be an excellent lower risk complement to stock ETFs for those who are looking towards retirement. Number five, international ETFs. Now, foreign stocks along with the US stocks and bonds are widely recommended for building a diverse portfolio. So that's where international ETFs comes in. So international ETFs, which may include investment in individual countries or specific countries' blocks, are an easy and typically less risky way to find these foreign investments. I hope you are getting something. Number six, Bitcoin or crypto ETFs. I know a lot of people will be interested in this, and this is very recent. Now, in January this year, 2024, the Securities and Exchange Commission of the United States approved a handful of spot Bitcoin ETFs, which directly tracks the price of Bitcoin, right? So this makes the cryptocurrency more accessible to average investors, as Bitcoin ETFs can be bought and sold directly in brokerage accounts. How interesting is that? So ETFs that offer exposure to other cryptocurrencies are still limited at the moment. This is just like barely 10 months after the approval by the SEC. Most crypto ETFs hold futures contracts or the stock of companies that either deal in or invest in the cryptocurrency markets. There are so many companies like Mara, BTB, and so on and so forth. Now, number seven, sector ETF. The US stock market is divided into 11 sectors, and each is made up of companies that operate within that sector. So sector ETFs provide a way to invest in specific companies within those sectors, such as the healthcare sector, financial sector, or industrial sectors. So these can be especially useful to investors tracking business cycles, as some sectors tend to perform better during expansion periods, while others do better during contraction periods. So often, sector ETFs can carry higher risk than broad market ETFs, right? You have to get a grip of this. Sector ETFs can give your portfolio exposure to an industry that intrigues you, such as gold ETFs or marijuana ETFs, with less risk than investing in a single company, right? Number 8, leveraged ETFs. Now, leveraged ETFs are exchange-traded funds that track an existing index, but rather than match that index's returns, they aim to increase them by 2 or 3 times. Did you get that? So it's important to note that they don't amplify that index gains by 2 or 3 times. They also amplify its losses. Please understand. The same way you make a lot of gains, amplified, you can also amplify losses. Imagine you had a traditional ETF that followed the S&P 500. If the S&P 500 went up by 2%, your ETF would likely also increase by about 2% because it holds most of the same companies the index tracks. I hope you understand that very well now. So if you had a leveraged S&P 500 ETF, that 2% gain could be, magnified and instead be a 4% gain. While that's great if the market is going up, it's not so great if the market is going down. This is what makes leveraged ETFs riskier than other types of ETFs. What's your take about this video? Do you have an ETF yet? Are you now convinced about investing in ETFs? Do you know better? Please let your comments be made known, and make sure you share this video. Keep following for more educative financial lessons in this channel.